Are all the banks worldwide about to all switch to XRP? Is this something that we can expect in 2026 and beyond? Listen up, because what you're about to hear is the real reason banks around the world won't have a choice when it comes to XRP. The global banking system is bleeding money every single day, and most people don't realize just how bad it is. Hidden behind outdated rails, correspondent banking, and liquidity traps is a cost structure so inefficient that once you see it, you can't unsee it. We are going to cover a lot in a very short window. So I need you, the amazing viewers, to get your coffees, get comfortable, and let's dive in. Hit the like button so this video reaches other amazing people just like you, and hit the subscribe button so you never miss an important update in the market. Now, amazing XRP viewers, let's get right into the good info. This is massive. Let's start with the biggest problem banks face today: trapped liquidity. The correspondent banking model forces banks to pre-fund accounts all over the world just to send money. These are called Nostro and Vostro accounts, and they lock trillions of dollars in place doing absolutely nothing. If a bank wants to send money to the UK, it needs pounds sitting there. If it wants to send money to Japan, it needs yen parked in advance. Multiply that by every currency corridor on Earth, and you get a system where capital is frozen, not flowing. That's not just inefficient, it's dangerous in a world where liquidity is king. Ripple proved this entire model is unnecessary. With XRP and on-demand liquidity, banks no longer need to pre-fund anything. Value moves when it's needed, instantly. That alone unlocks an estimated $27 trillion sitting idle across global banking. No CFO on earth ignores that kind of balance sheet liberation. Now let's talk about coverage, because this is where things get uncomfortable for skeptics. Ripple already provides access to over 70 payout markets, representing more than 90% of the global foreign exchange market. That's not a roadmap promise. That's operational reality. Since 2016, Ripple has processed tens of millions of transactions representing tens of billions in notional value, all without requiring pre-funding. This matters because FX is the bloodstream of global commerce. Every supply chain, every multinational payroll, every cross-border investment depends on FX liquidity. When one system can already touch 90% of that market while eliminating pre-funding entirely, the competitive pressure becomes unbearable. Banks don't switch because they love innovation. They switch because the old system becomes too expensive to defend. Now let's break down the math that changes everything. Global FX markets move roughly $7.5 trillion every single day. These transactions happen over the counter through banks, brokers, and intermediaries. The average transaction cost ranges from 1% on the low end to 3% or more on the high end. Even if we're generous and assume just 1%, that's $75 billion per day in costs. At 3%, that number explodes to $225 billion per day. That's not revenue, that's friction. That's money burned just to move value. Now compare that to the XRP ledger, where transaction costs are fractions of a cent. Running the same volume through XRP would cost roughly $1,500 per day. Not millions, not billions, $1,500. The difference isn't incremental, it's existential. When you annualize those savings, the scale becomes almost absurd. Saving $75 billion per day over 365 days equals roughly $27 trillion per year. That's just FX, that's not derivatives, that's not equities, that's not bonds, that's not cross-border remittances, that's one slice of the global financial system. No industry on earth can ignore a technology that offers a $27 trillion annual efficiency gain. Banks are profit-seeking entities, but more importantly, they're risk-averse. Once one major institution adopts a system that dramatically lowers costs and improves liquidity, every other bank is forced to follow or die slowly under legacy expenses. Now let's zoom out and look at stock markets. Major exchanges like the NYSE and NASDAQ process roughly $200 billion in volume per day. Trading fees, commissions, and hidden costs often range from 1% to 2% when you account for intermediaries, clearing, settlement, and custody. That's roughly $4 billion per day in friction. Using a blockchain-based settlement layer like the XRP ledger, the cost drops to a few $100s per day. On top of that, settlement becomes instant instead of taking days. That means capital isn't locked during clearing periods, counterparty risk collapses, and markets can operate 24/7. When markets realize they can save billions daily while increasing speed and access, resistance disappears very quickly. This is why banks are actively upgrading their infrastructure. Legacy messaging systems, fragmented standards, slow settlement, and high liquidity requirements are no longer defensible. ISO 20022 is part of this transition, but it's only a bridge, not the destination. Ripple can integrate with banks in weeks, not years. Traditional banking system upgrades often take 6 to 18 months. Ripple implementations can be live in as little as a few weeks. That speed matters because financial institutions are under constant pressure from regulators, shareholders, and competitors. When one solution is faster, cheaper, and already compliant, the decision becomes straightforward. Tokenization accelerates this even further. Ripple isn't just about payments. It's custody, token issuance, settlement, and liquidity wrapped into one enterprise-grade stack. Major institutions are already working with Ripple to tokenize assets, manage custody, and streamline settlement. Banks don't want 10 vendors. They want one trusted system that scales. Ripple provides that. As tokenized assets grow into the tens of trillions, the rails moving that value become more important than the assets themselves. XRP sits at the center of those rails, acting as a neutral bridge asset that removes currency risk and friction entirely. Now let's talk about cross-border payments beyond FX trading. Globally, hundreds of billions of dollars move across borders every day for trade, remittances, corporate payments, and institutional transfers. Fees for these transactions often range from 2% to 7% depending on corridors and intermediaries. That means tens of billions of dollars per day are lost to fees alone. Using XRP, the cost drops to near zero. Estimates show potential savings of nearly $10 trillion per year just in cross-border payment efficiency. Combined with FX savings, we're already well past $35 trillion annually. This isn't theoretical. This is arithmetic. And here's the part that impacts everyday people directly: payroll. People get paid weekly or bi-weekly not because it's ideal, but because payroll is expensive and slow. Blockchain removes that friction. With XRP-powered rails, people can be paid daily, hourly, or even in real time. That changes lives. Cash flow stress disappears. Short-term debt becomes unnecessary. Entire economic behaviors shift. Banks understand this because payments frequency increases engagement, deposits, and product usage. Removing friction doesn't just save money. It unlocks new economic models. A lot of people still confuse Ripple and the XRP ledger, so let's be clear. The XRP ledger is decentralized, fast, energy efficient, and capable of handling massive transaction volumes at negligible cost. Banks can run validator nodes. Governments can run nodes. Universities already do. Consensus is achieved globally without mining, making it scalable and future-proof. On top of that, the ledger supports tokenized assets, sovereign currencies, commodities, and private instruments. When tens of trillions in value flow through a system like that, price discovery changes dramatically. Utility becomes the driver, not speculation. Now bring derivatives into the picture. The derivatives market is measured in the hundreds of trillions. Even a small fraction moving onto blockchain-based settlement rails would dwarf every crypto narrative we've seen so far. Institutions are already positioning themselves. Exchanges, custodians, and liquidity providers are integrating XRP ledger infrastructure because they see what's coming. When derivatives settle instantly with near zero cost, counterparty risk collapses and margin requirements shrink. That alone frees massive amounts of capital. Again, banks don't have a choice here. The competitive advantage is too large. At the end of the day, this transition isn't ideological, it's mechanical. When a system saves tens of trillions of dollars per year, unlocks trapped capital, reduces risk, and increases speed, resistance collapses. Banks will switch to XRP not because they want to, but because they have to. The math forces them. The competition forces them. The market forces them. And once the switch accelerates, it won't be gradual. It will be sudden, structural, and irreversible. That's why understanding XRP now isn't about speculation. It's about understanding where global finance is heading before the rest of the world catches up.